Exploring the currency market. Whether you trade stocks, commodities, currencies, or real estate. On Mars, it is important to understand the marketplace in which you are working. If you have a little market experience, if you are new to currencies, or if I want to brush up on market basics, this chapter is for you. This chapter does not contain an exhaustive history of the modern foreign exchange forex market. Instead, we'll look at the market from the perspective of an active trader. You will learn about the roots of the market, its structure and participants, how currency trades are executed, and the tools used to conduct business if you have experience at trading of the markets. This chapter will brief you on the unique attributes of the currency market. If you have little or no experience in trading, the contents of this chapter are an essential part of learning the business of currency trading. What is Forex? The currency market, or more specifically the Forex market, derives its name from the generic term foreign exchange market. The Forex market is a centralized global network of trading partners, including banks, public and private institutions, retail dealers, speculators, and central banks involved in the business of buying and selling money. The Forex market is a spot market, which means it trades at the current market prices determined by supply and demand within the marketplace. This differs from currency futures traded in the commodity exchange in the United States. 1. Which trades a contract price for delivery in the future. In the spot market, you are trading cash for cash at the current market price. The Forex market is the largest, fastest growing financial marketplace in the world. Every trading day, the Forex market handles a transaction volume nearly $3.2 trillion, according to a survey done by the Triennial Central Bank in 2007. To put that figure in perspective, the average daily volume on the Forex market is nearly 20 times larger than on the New York Stock Exchange. The need for foreign exchange is driven by travelers, multinational corporations, and governments. Tourists from the United States need euros for the European vacations. Corporations such as Microsoft exchange profits made overseas into US dollars. Governments hold reserve currencies and manipulate the money supply while they implement their monetary policies. The Forex market was created to facilitate the sale of currency to customers who intend to take a delivery of the currency. However, the vast majority of trading need and be speculators seeking nothing more than profit. Forex roots. The roots of our modern Forex market are an interesting topic that has been covered ad nauseum by other trading books. However, I do believe it is important to have some knowledge of the market's history, so this section covers the key points. If you have never studied global monetary systems, consider this section an abridged history of the Forex market. The modern Forex market's roots began with over-the-counter currency trading established by banks throughout the 1970s and 1980s, following the collapse of a post-war era monetary system known as the Bretton Woods system. Bretton Woods was established in June 1944, as World War coming to a close. The Allied nations sought to establish a new monetary system to promote a global investment and capitalism to eliminate the challenges of a gold standard system. Under the Bretton Woods monetary system, member nations agreed to value their currency at parity to gold plus or minus 1% and then set their exchange security against the US dollar. An exchange, the United States agreed to peg the dollar against our gold standard of $35 per ounce and guarantee its exchange for gold. This promise by the US government effectively made the dollar a global payment standard instead of using our gold standard. The phrase, good as gold, was frequently used to describe the US dollar under the Bretton Woods monetary system. Although the system worked to foster investment and capitalism, it also encouraged a tremendous outflow of dollars into overseas currency reserves. The world needed dollars to support a global payment system based on the dollar, and the United States was content printing more money. The United States assumed it could balance the deficit with trade. Unfortunately, the outflow of capital finally caught up to the United States in 1950 and the country began posting a negative balance of payments, despite the government's best efforts to increase trade. As inflationary concerns loomed on the horizon, the United States found itself in a difficult position. Failing to supply the global demand for dollars would bring the monetary system to its knees, whereas continuing to print money would eventually threaten to devalue the dollar. Confidence in the U.S. government's ability to maintain a gold match standard for the dollar began to wane, and speculation grew that a serious devaluation in the world's primary reserve currency was inevitable. In August 1971, President Richard Nixon finally intervened by suspending the peg dollar had against gold. The Bretton Woods era of a fixed exchange rate system was over. Policy steps were taken to implement a floating exchange rate system, which is the cornerstone of today's modern forex market. In the 1970s, trading desks were established among major banking institutions to facilitate currency transactions for major clients. This private trading arrangement was known as the interbank atom, still used today to describe the electronic trading arrangements among major banks, institutions, and currency dealers. Today, prices are determined by the forces of supply and demand within the forex market, allowing traders to capitalize on small swings between the exchange rates of two currencies. Forex participants. Forex has a diverse population of participants, ranging from Japanese housewives to powerful central bankers. The objectives of the participants differ, and their individual actions may have dramatic effects on the market. It is important to remember that the forex market is an off-exchange marketplace. There is no central exchange where all orders are cleared, as on the New York Stock Exchange or the Chicago Mercantile Exchange. The bulk of trading is done between trading partners on the interbank. However, small retail traders are unable to trade directly with partners on the interbank. Therefore, some participants in the forex market exist to create a marketplace for others. Currency dealers create a market for smaller retail speculators and offset their risk by trading with their larger partners in the interbank. The hierarchy of forex participants is illustrated in Figure 1.1. There is a definite food chain among forex market participants, with interbank members and top and retail speculators on the bottom. Figure 1.1. The flow of forex market participants. The interbank. Interbank is a system held over from the early days when banks traded for clients and themselves over the telephone. Today, trading is conducted electronically, with quotes from buyers and sellers matched upon the interbank market automatically. Many interbank members act as market makers for the currency pairs traded on the spot currency market and offer quotes that ultimately drive the pricing you see in your trading software. Among the largest market makers in the interbank are banking giants such as Citi Group, UBS, Goldman Sachs, and Deutsche Bank. Lehman Brothers was a major interbank market maker prior to its demerger in September 2008. Participants on the interbank are big dollar players. Since the lowest accepted trader size is at $1 million, it isn't uncommon for orders larger than $100 million to be executed on the spot forex market due to the global size and liquidity of the interbank market. Many banking participants want the interbank fill orders for customers who actually intend to take a delivery of the currency being traded. However, most interbank members also trade the bank as money speculators attempting to make a profit just like any other currency trader. The advantage interbank market makers have over a regular retail trader is access to order flow information. If you are the market maker and you seal orders, you have insider information about the direction of the prices. Taking a trade against that information provides a sign of a source of revenue for many financial institutions. Interbank members trade only with partners with which they have arranged credit agreements. This is an important point to understand because it affects the pricing you receive from your currency dealer. The quotes flowing from interbank trading partners ultimately drive the pricing you see through your currency dealer's trading software. The more trading partners a dealer has, the more quotes at which they can execute a trade, resulting in more competitive pricing for you. You should look for a currency dealer with multiple liquidity feeds. Institutional traders. Institutional traders represent corporations or hedge funds trading directly with the interbank or through retail currency dealers. Hedge funds may participate as speculators while corporations participate to protect their interests against exchange risk. Corporations conducting business globally foresee potential issue of fast-moving exchange rates, devaluing their profits made overseas. These corporations may participate in the currency market, be hedging their risk directly and the currency market rather than waiting for a bank to exchange the currency for them. Most institutional traders representing corporations are involved in some kind of hedge to protect the value of their goods or services from exchange-related risks. Institutional traders may include a professional money managers looking to diversify and hedge against the risk of loss in the equities market. Central banks. Central banks play an important role in guiding the forces of supply and demand for a country's currency. On the forex market, their monetary policy statements, interest rate decisions, and ability to intervene in the forex market should make every trader pay close attention to their actions. Central banks are also tasked with controlling the money supply of a nation's currency, which directly affects supply and demand. Low supply and high demand tend to increase the value of a nation's currency, whereas high supply and low demand will devalue it. Balancing growth with inflation is the typical goal of central bank policies. Central banks may also change their overnight lending rates as a tool against inflationary pressures. The interest rate set by a central bank can influence the value of a currency based on yield. The higher the central bank rate, the higher becomes the yield for holding that currency, influencing demand. Table 1.1 lists the central banks and their internet addresses for major currencies traded on the forex market. Retail currency dealers. The average retail trader does have a credit or capital required to participate directly with interbank trading partners. Retail currency dealers act as market makers for small volume currency traders. Currency dealers manage their risk by balancing their portfolios of retail orders among the customers for which they are making a market. When they are overexposed to market risk due to an imbalance of short or long orders, they. Table 1.1 Central banks around the world. Currency central bank website. United States dollar, the Federal Reserve Bank, Great Britain pound, Bank of England euro, the European Central Bank, Canadian dollar, Bank of Canada, Australian dollar, Reserve Bank of Australia, Japanese yen, Bank of Japan, New Zealand dollar, Reserve Bank of New Zealand. Offset their risk by taking positions with the trading partners on the interbank. It is important to understand that currency dealers do not operate the same way stockbrokers do. The spot currency market does not have an exchange, therefore, the currency dealer often fills a customer's order by itself, assuming the risk. This is commonly known as taking the other side of the trade. In other words, the currency dealer is betting against your ability to make money. If you lose, the dealer wins and collect the spread for doing the transaction. This is significantly different from a stockbroker, who is paid a commission for brokering your order to the exchange, where it is matched with an anonymous third-party order in the exchange. There is an inherent conflict of interest when your dealer is profiting by taking the other side of your trade. Traders have historically complained about poor order execution, excessive quoting, or stops being gunned, and there is probably some basis for these complaints. Forex, after all, is an unregulated market, and shady dealers do exist. Currency dealers are aware of the perceptions as well, and are no marketing, no dealing, disk execution, or direct interbank trading as an alternative order execution strategy to taking the other side of the trade. The set trading platform suggests the dealer is not involved with your trade and passes the order directly to trading partner. Whether every order is matched anonymously on it is a matter of trust, but it doesn't hurt to do business with a dealer who offers an alternative to taking the other side of every trade. Retail speculators. Retail speculators may be trading their own account or client funds through a managed account program. Some speculators at the retail level may be trading for clients looking to hedge risks. However, most are looking to generate profit. Retail speculators are too small to trade directly one the interbank and clear their traders thrown of the money retail dealers available to make a small volume market for them. For the most part, retail speculators represent people like you and me, trading small volume accounts purely for the sake of making a profit. The number of retail speculators involved in forex world where you can invest to grow the popularity of currency trading grows. Forex versus exchange markets. The forex market is not structured like a traditional exchange market such as the New York Stock Exchange or the Chicago Mercantile Exchange. Forex is a decentralized global marketplace where trades are cleared on and between trading partners. There is no central exchange, no pit full of yelling traders, no big board of quotes on a New York street, and no closing bell ring. The pros and cons of an exchange-based market versus off-exchange currency trading are debatable, but here are obvious differences you should understand before trading in the forex market. No transparency. One clear advantage of an exchange-based market over off-exchange currency trading is the transparency the exchange offers traders about the market. Exchanges clear every trader through a central exchange, allowing them to provide traders with a wealth of information about the market activity. Common tools such as order flow and volume data are displayed in traders' charts, allowing them to gauge the strength or weakness of price movers throughout the trading day. Because the forex market is decentralized, there is little data available on market activity. Market makers and retail dealers typically don't share their order flow data, and those that do only represent the trading desk activity and not the forex market at large. Volume is another popular indicator used by stock and commodity traders on exchange markets that is unavailable in the forex market because there is no central exchange on which to measure volume. Currency traders must learn on their own to read price action through their charts without the aid of exchange-based indicators. Little regulation. The forex market has been known as the Wild West of financial markets due to the lack of regulatory oversight. The global nature of the forex market presents a problem for local government agencies to police trading activity around the world. Currently, there are no regulatory requirements for an institution to establish itself as an interbank participant. However, any reputable retail currency dealer will register voluntarily with the local regulatory agencies. We already pointed out that the regulatory authority over the off-exchange retail currency market through the 2009 Farm Bill. Right, this text is proposing new regulations that will require dealers to register as members of the NFA. In the United States, the National Futures Association (NFA) has begun implementing rules designed to protect currency traders, although some of its recent decisions have been met with skepticism. In 2009, the NFA banned a practice known as hedging, which allowed a currency trader to maintain opposite positions in the same currency pair, and implemented order execution rules, forcing changes in some dealers' trading platforms. Although the rules are designed to make trading operate closer to the futures and equity markets, some traders resent the presence of regulators making changes to a market that has been self-regulated since its creation. No trading restrictions. Freedom to trade in whichever direction you see fit at any time you see fit is a key feature of the forex market. For years, the Securities and Exchange Commission (SEC) enforced a rule against short-selling stocks known as the uptick rule. The uptick rule attempted to prevent speculators from intentionally driving down the value of a stock with relentless short selling. Under the uptick rule, a trader could only sell a stock if the current price was above the sale price or on an uptick. Once the stock was falling, traders could not sell the stock again until the next uptick. Although the uptick rule was suspended in June 2007, there have been plenty of calls to reinstate it following relentless stock market selling in 2008 and 2009. The forex market has no restrictions in trading. If you believe that the euro will fall against the dollar, you can sell it without restrictions. Currency traders are able to move in and out of positions freely, without an uptick rule or other regulatory restrictions. Having no restrictions on trading can also be a negative factor of the forex market, since the market is unregulated and there are no restrictions on trading activity, the environment for manipulation exists. An extreme example of manipulation is the intervention by central banks. Intervention is a process of buying or selling tremendous amounts of currency to manipulate the exchange rate. The Bank of Japan has a history of intervening in the yen when its central bankers are displeased with the exchange rate. Manipulation can take many forms, from intervention to quoting a trader's order to favor the dollar's books. You should beware of the risks involved with trading off exchange in the spot market before you commit any live money to a trade. It's called the Wild West of trading for good reason. Contract flexibility. Trading on exchange-based markets and the forex market is conducted in standard contract or lot sizes. Unlike the exchange-based market, the forex market doesn't set restrictions on the size of a single contract. Theoretically, you could place a single trade worth $1,384,284,927,944.01, assuming that you can find someone able and willing to take the other side of your trade. Dr. Evil, perhaps. Currency dealers and retail market, they've carved up a standard $1 million interbank lot into 3 smaller lot sizes accessible to smaller retail traders, known as standard lots, mini lots, and microlots. Standard lots on the retail side of the currency market are equal to 100,000 units of the base currency. Mini lots are equal to 10,000 units of the basic currency. Microlots are equal to 1,000 units of the basic currency. Some currency dealers have for traders in single units, allowing a trader to place an order for 13,428 units rather than a conventional at size. This gives the trader a very precise position sizing capability that's unavailable in traditional exchange-based markets, or it might be singly dollar, euro, yen, or whatever the denomination of your account. For example, a trade of 10,000 units is synonymous with a $10,000 position if your account is denominated in US dollars. Micro accounts offer new traders the ability to trade real money without placing a tremendous amount of money at risk. Typically, a micro account measures profit and loss in terms of a single dollar per pip or even less, depending on the margin requirement deployed. The Zesmalos are a great place for a new trader to cathisti than live money trading, and say has demonstrated he can trade profitably in a demo account. They are also useful accounts for testing theories with a live money account. I keep a micro account with less than $1,000 in it for testing strategies in live markets with live money. Overall, micro accounts are a great option to get started with, even if you have $100,000. Transaction costs. Currency dealers heavily advertise that there are no commissions for trading currency, but that doesn't mean the forex market is cheap to trade. Currency dealers earn their money through the spread, which is the difference between the price at which a dealer will sell a currency and the price at which the dealer is willing to buy it back. For most major currency pairs, the spread is very small, but the costs associated with that spread vary depending on the margin and leverage your account has used. You'll learn more about currency pricing shortly, but for now understand that the transaction costs of trading currency on the forex market. Table 1.2 Transaction costs across market types. Commission contracts, total trade type or spread traded transaction cost. Common stocks $9.95 per leg, 10 $19.90. Options $12.95 per leg, 10 $25.90. Currency futures $3.50 per contract, 10 $35. Currency forex 2 pip spread, 10 $200, $10 per pip. Can be significant for traders who trade frequently. Transaction costs can be a significant amount of money to become a reach profitability. Fortunately, the forex market is a fast moving on, and until you clear the price of the spread, there are no further transaction costs. The more interbank trading partners a currency dealer has, the better that dealer's pricing will be. Dealers with more than one or two interbank partners are able to take advantage of more quotes and pass them on to you. Table 1.2 illustrates the difference in transaction costs for trading 10 different contracts across various market types. Although there is no commission, the forex market is certainly not a cheap market to trade. These prices were taken from the publisher commissions of a major broker's website. The cost of the currency spread assumes a euro US dollar transaction using leverage of 101 trading hours. The forex market is a global marketplace and trades 24 hours a day, 5 days a week. This around-the-clock trading environment is not unique to the forex market, but certainly does make it easier to manage your trades around a schedule that fits your lifestyle rather than certain market hours. In the United States, the forex market begins trading Sunday evening as Asian markets open for business and continues to trade until the New York markets close on Friday afternoon, however, just because the market is open 24 hours a day doesn't necessarily mean anything interesting is happening. There are three major trading sessions that account for the majority of volume seen throughout the trading day. C. Largest trading session B. Volume I. The London session. London is uniquely positioned in a time zone that's open for business during work hours stretching from Dubai to New York. The London trading session accounts for the most price action and volume in the forex market. B. A long shot. New York follows London its second largest trading session. Tokyo or Thesian trading session rounds out the top three. Table 1.3 Trading Session Timetable. Trading Session Open Close. London 3 a.m. 12 p.m. New York 8 a.m. 5 p.m. Tokyo 7 p.m. 4 a.m. Table 1.3 lists the three major trading sessions in the Forex market and the times during which they're reactive. The times are listed in Eastern Standard Time. Many trading strategies depend on the activity seen during the higher volume trading sessions. For many traders who work at day jobs, it is impractical to trade during a trading session that happens while they sleep or are at work. This book focuses on placing trades around supply and demand levels during the quiet of the market. Around your schedule, it is better to plan and enter long-term trades during the quiet hours of the market and leave the trading sessions to day traders who enjoy staring at charts all day.